Nolan, so good to see you. Today we have some tax tips. Don't let the IRS keep your money. Of course, we always like to talk through year-end tax planning, but as we record today, it being, December 16th, some of these moves you might not have time for in 2025, but never too late to start thinking about 2026. And you still have time to, of course, max out your 401k.
Yeah, this is probably the first place that people go when they're trying to reduce their taxable income is how much can I put away into a tax deductible account? 401k is a great place to put it. As you mentioned, we're maybe a little bit close towards the end of the year. These are always things that we can take into 2026 as well. But when you have $23,500 that you can go put into a pre-tax 401k, it's a direct deduction to your income. It's a nice thing to do. You can put it in a Roth as well. The downside of that is you have to pay taxes in the year you put it in, but you never have to pay taxes on the Roth portion, again, barring one or two strings attached. So yeah, max out 401k. It's a great place to go if you're looking for something to do at the end of the year. It's a good first place.
Yeah. Similarly, max out those health savings accounts.
Yeah, HSAs, these are available to people who have high deductible health plans. So if your health plan is a high deductible plan, and you can ask your employer if it is, you'll have the ability to put money into an HSA. The money that you put into an HSA is tax deductible, which means it reduces your current income. Your growth in that account is tax-free. And then when you make withdrawals for qualified medical expenses, there are lots of them, it's tax-free when you take it out as well. So HSAs after the 401k, another really good place to go.
Right. All right. Number 3, this is for all of our procrastinators out there. Not too late. Consider maxing out your Roth IRA because we have up until the tax filing deadline.
Yeah, the Roth IRA is a good place to go up until April 15th, usually of the following year. You have the ability to put money into a Roth IRA or traditional IRA. It's important to meet with either your advisor if they give tax planning advice or with your accountant to determine which one might be most appropriate if your goal is tax savings. A lot of people, when they're putting money into Roths or traditional IRAs, might not understand how it shakes out the coming April. So if in the year you're trying to save taxes, you may want to put it into a traditional. If long-term, you just don't want to pay taxes on it ever again, you may go Roth, even if it increases your taxes this year.
And then this is a good strategy, no matter the time of year. Sell your stock losers. This is known as tax loss harvesting. How does it work?
So tax loss harvesting is where in a taxable account, so a non-IRA account, you have investment gains. The past couple of years, we've had tremendous gains in the stock market. So combining those gains with losses in the same accounts or different accounts, it doesn't much matter. You can wash away some of the taxable obligations on the investment gains. So year-end maneuver might be, hey, I've had all these stocks go up in value, but one real dud. If I go sell all these for a capital gain and then sell that one that's been a dud for a loss, you can offset some of the capital gains. So that's tax loss harvesting.
And then last, be tax smart and do good. Donate to charity.
Yeah, donating to charity is a great place to go if you're trying to reduce your taxable income because you get a reduction in your adjusted gross income for the amount that you donate. Now, even if you don't itemize, you can get an extra deduction. There are new laws coming out so that it's more beneficial to donate to charities and you get bigger bumps even if you don't itemize, which not many people do these days.
Right.
So donating to charity is very good. You can do so through QCDs or qualified charitable distributions. These are charitable donations from your IRAs over to your charities. We usually do these for folks throughout the year. So if you're kind of donating to your church and they have a special project and you'd like that money to come out of your IRA, you can write them a one-time check and have it go towards that. So there's lots of ways that people do that. QCDs are a very good way to do it, but donating to charity in general, great way to reduce taxable income, and you're also doing a lot of good with that money as well.
Yes. QCD is such a win-win for everyone. Well, Nolan, again, all the love in the world to procrastinators. Not too late to start thinking about 2026 too. So if somebody would like to sit down with you and talk more about strategic tax planning, what's the best way to reach you?
Well, Erin, they can call at 616-301-2581 or our website, cornerstone-rp.com, and there's a contact us box at the bottom of the page.
All right. Nolan, thank you so much. I appreciate it.
Yep. Thanks, Erin.